Hello, welcome to welcome to the webinar. My name is James Hughes, Chief Market Analyst here at SM Invest. Thank you for joining, and thank you for being part of these webinars over the last few days. We've done one every day this week. Apologies if you couldn't. Excuse me. Apologies if you couldn't join yesterday. We had a few technical issues, I think, but we managed to send you guys a recording of yesterday's webinar. If you didn't get that, please send me a message in the Q&A or in the chat, and I will make sure that you get a copy of that. I'm more than happy to make sure you get a copy of the recording. The recording of all of our webinars is on our YouTube page, so they all go onto the YouTube page. So that's important, that if you do want to go back and have a look at any of those, then you can do. But let's have a quick little brief look at how markets have been trading over today. Now, obviously, I'll tell you a little bit about today. We're going to go for about half an hour or so, maybe slightly longer. We will look from where we've been over the markets, but obviously the title of today's webinar is about Bollinger Bands. So Bollinger Bands are a form of technical analysis, and they go on your charts, and we'll show you exactly how to use those, how to get involved in those, and how to use those. So by all means, please, it'll be excellent if you could if you do have any questions, please ask. But as I say, we'll run for about half an hour or so, and then we will call it a day. So let's look at how markets have moved. Positive today is what we're looking at. This is a 15-minute chart of the Dow Jones. 25th yesterday, we saw a little bit of a sell-off right towards the end of the session, which was interesting because we were trading to the upside really aggressively, looking at following on from what we'd seen in the last couple of days, a real positive week in terms of markets. We're now trading up 22,000, above 22,000. And the key thing that we've done today is that we have taken out these highs from yesterday. So these highs from yesterday, 21,904 is where we were. I don't think it was the high from yesterday though. If I just take this back a tad, was it the high from yesterday? Yeah, it was the high from yesterday. So the high from yesterday is taken out, pretty much 22,000. 22,000 was the high from yesterday. And what's interesting today is we've had a real strong reaction in terms of markets, but this has come after we saw some really terrible numbers out of the US at 12:30 today, UK time. We got numbers from the US. Now we got two sets of numbers from the US today. One was the GDP number. One was the US GDP number, which came in. The GDP number was kind of a non-event number really today, because it doesn't really give us an indication as to what's going on in terms of overall markets, because it's a lagging indicator. So that data doesn't really hold anything apart from the Q4 numbers, so which would have been didn't have any coronavirus attached to them at all. Now, what we do have today has been the initial jobless claims. And I just want to share with you something on my screen now. I just want to share with you this. Now, the initial jobless claims, they are a weekly number. These numbers come out every single week. Usually, we're looking at a number around 200,000. Sometimes it jumps to 500,000 when it's particularly bad, but around 200,000, 300,000 is usually about right in terms of our average for this number. Well, the number jumped today to 3.2 million, and this is the number of US individuals who are claiming unemployment benefits in the space of 1 week, and the jump of 3.2 million is, as you can see, astronomically the largest that we've ever seen. Since 1967, when these numbers were calculated, that's the highest we've ever seen. So incredible number to see these markets go up, to see this number go up to that. And it shows you, really, it gives us an indication of just how bad the picture could potentially get going forward for these financial markets and for the economy as a whole. Because, of course, we've been talking about exactly how how we perform, how markets are trading, you know, how we've seen such a negativity and how it's going to be so much worse than 2008. But what it also shows us, of course, is the fact that we know the economic impact is going to be bad, but just how bad we didn't know. Well, this gives us a very stark, clear indicator that things are going to be particularly bad for the market here. So it is a particularly poor number, and this is just the beginning, there. So let me share with you back in here to the platform. Actually, there's other thing I want to show you, and I've taken this from somewhere else. I've taken this from a good friend of mine, actually, who I've taken this from a good friend of mine, actually, who I used to work with, a man called Ashraf Laidi. Now, this shows you, he works in, he's an Arabic guy, and this is why this is on his website, so hence the Arabic at the bottom here. But what we have is this chart, Dow Jones Industrial, the average. This red is the February-March 2020. This is the downside fall that we've seen from this year. The white line is the 1929 depression. Okay, the depression that ran all the way through 1931. That's what this shows. Well, the comparison could not be more identical. The comparison could not be more identical. We're even jumping up to this exact sort of move that we'd seen previously. This low down here is 48% from the highs. Now the highs are also identical. 48% from the highs. Our low currently was 37% from the highs. You can see what we potentially have coming if this is the case. Okay, this is what we could see, and this is where we are at the moment. We are seeing that upside. Okay, we are seeing that upside. And for anyone who was thinking, well, okay, these markets, maybe we are in a different sort of time now. We are in a different kind of picture. Well, this shows you that the upside that we're seeing is not the end of the downward moves, and it's very easy for us all to jump in and go, okay, I think I think we're now changing the market that we're in is changing because of the upside that we're now seeing. Just not the case. It's just not the case. Now, I want to take you back. I can't take you that far back on here. I can only take you back how far? Oh, if I take you on a monthly chart, how far can I take you back? I don't think I can take you far back at all. No, I can only take you to 2006 on here. I can't take you any further on this chart itself, but you can see the issues that we've had in terms of these markets. Everybody knows the issues that we've had in terms of these markets, and the continuation is obviously there. But let's look at Bollinger Bands. Let's look at what we were talking about in terms of Bollinger Bands. Now, I want to, if I could just get this to the front, that'd be excellent. There we go. I want to talk to you about, obviously, Bollinger Bands are a form of technical analysis. And those of you who have joined us over the last couple of days would know that obviously technicals are a little bit all over the place at the moment. They don't really give us too much to go on because technical analysis isn't necessarily being followed that much because of how fundamental the news is. Now, on Monday, I told you what fundamental news is. And tomorrow, in tomorrow's webinar, I will look at exactly the difference between fundamental and technical trading. But so please feel free to join into that one tomorrow. But the technicals aren't necessarily really listening to what's going on in the market. However, we do want a form of technical analysis which will give us an indication of how these kind of markets will work. Okay, well, let's look at them. Bollinger Bands. What are they? Well, first of all, let's add them to your chart. Let's show you how you add them to the chart. Insert indicators. Insert indicators. Trend. Bollinger Bands. Now, when they open up, you get this indicator here. Now, what they are, it's a technique that was, the reason it's called Bollinger Bands is because it was done by someone called John Bollinger. That's who made it. So hence why it's called Bollinger Bands. Now, what it does is it puts two trading bands, 1, 2, around the price action. Okay, but it's not only going around the price action, it's going around a central moving average in here. So this moving average in here. Now, usually the moving average that we use is a 20 period moving average. 20 period moving average is what we tend to use. You can use other period moving averages, but 20 tends to be the textbook version that we tend to use. Now, it uses the envelope technique of trading, except that Bollinger Bands are placed 2 standard deviations above. So you have your Bollinger Band here. The upper band is 2 standard deviations above. The lower band is 2 standard deviations below. Okay, so that's how they tend to be calculated. Okay, and obviously, as we said, the moving average in the middle tends to usually be 20 days. That's the basic, but it can be a lot more. Can be more, can be less, but it can be more. Okay, now, those of you who don't know what a standard deviation is, now standard deviation is basically a statistical concept that describes how prices are dispersed around an average value. Okay, so the average value is in here, and using 2 standard deviations ensures that 95% of the price data, so this data here, the actual candles, it tells us that 95% of that is within our price range. Okay, it's within the band range. Okay, so that's how that's why we use 2 standard deviations. And as a rule, prices are considered to be overextended when they touch these upsides. So overbought, basically. So overbought, meaning that the market's going to turn around and come lower. And when they come to the bottom line, we tend to say that they are oversold. Okay? We tend to say that they are oversold on the downside. Okay, so overextended, overextended on the upside and overextended on the downside, or overbought and oversold. That tends to be the way that tends to work. Okay, so that's the situation that the Bollinger Bands gives you on the chart. Okay, that's what it gives you. So what we want to know is how we use them, basically. How are they used, and how do we make money from trading with them? Well, that's the key thing. Now, you can use them for 2 different things. First of all, as you can see on this chart that we have here, it's not particularly helpful because the market is ranging so much, is fallen so much, and the volatility is enormous. Now, there are 2 ways to use the Bollinger Bands. Number one, as targets. So I'll talk to you about targets in a moment. But secondly, is with using the outer bands, so the higher one and the lower one, using them as a form of volatility measurement. So what this gives us is it says the wider apart that these markets are, the wider apart, not markets, these bands are, the more volatility that there is in the market. And if that's happening within a trend, as we can see at the moment, a severe, massive downtrend, the wider they get, the more likely they are to turn around. So the more likely the stock, index, currency, whatever it may be, the more likely it is to start flipping itself around and flying higher from a low point, or if it's on the upside, flipping itself around and coming lower. So that's what we look at. Okay, that's why we look at these 2 things. Okay, that's the situation. Because, and we can see that in this situation, to be perfectly honest, on the Dow. Because on the Dow, we're looking at the fact that we're down here at this low point. And if we look at how wide this got, I'll just show you how wide at its widest point. So its widest point is probably, now actually we're not actually showing the whole amount here. Look, let's just, there you go. So its widest amount, its widest side is probably about there. So that's on Monday. So at the height of the volatility. And what it says is at their widest point, and this is in the textbooks, in the textbooks, because it tells you that at that widest point, that's the time when the market is expected to start to turn itself around. That's when we're expected to see a kind of change in the volatility, a change in the trend. And that, if you look at where we are now, is exactly what we got. We got that exact change, that exact turnaround at that point when those bands were widest. Then the market started to come higher, and we are where we are now. So a key movement on the Dow Jones here shows you that situation. Now let's add it to something else. Let's add it to a currency and see how it works from that point of view. Let's add it to Eurodollar. So Eurodollar with Bollinger Bands on, just gonna change that a little bit so you can see it slightly better. Again, we're the same, 20 periods, 2 standard deviations. Just gonna get rid of that other moving average. Okay, so it works very similar on a currency pair. At its widest point, at the low point, you can see a turnaround in the market. Very similar. But let's look at it on when the markets aren't necessarily doing that. Now, the way we can also use Bollinger Bands are not just to signal the fact that when a trend is going to turn. So basically, let's just write this down, shall we? Just going to annotate this quickly. So, number one, Bollinger Bands help when wide are showing a potential trend change. That's fine. Number two, let's talk about number two now. Well, number two shows us a situation where they give us price targets, upside and downside. So the second way we use them is as price, the upper band and lower band give us price targets. So that's what that gives us. The upper band and the lower band give us price targets. Okay, so you can see the situation here and how this would usually work in a market that is ranging. It would give us an indication to say, okay, if the market drops below the moving average in the middle, so if it drops below this middle moving average, then that gives us in this case, market coming down, gives us an indication that we're looking to turn around. So that would be our selling indicator, our selling signal to break below this lower point. And then our lower band would give us our price target. So what we would say would be, and again, let me annotate this for you. We would say a break. No, not like that. We'd say a break here. That's where we would look to sell. And we'd look to sell, obviously, because this is coming down. So a break below here would show us the market selling. But then we would have a target. And our target would be right here. That would be our target. So there's our target. And that's how we would use a Bollinger Band in this situation. Selling signal if it breaks below here, target if it goes there. Okay? You can see that. You can see that could be the situation. And that's using number two here. Upper band and lower band giving us price targets. Now, at the moment, this isn't giving us a price target, is it? Because it's trending. So if the market's trending, it's not going to give us that signal, is it? It's not going to give us a signal. So what we would look to do, we would look to say, okay, well, at the moment, when the market comes down to the moving average, we just use the moving average as a form of sloping support and resistance, which is what moving averages act as anyway. It would only be on a break of this. So a break of that, this level here, the 20-period moving average, that would give us the selling signal. Then we would have our target in here. Hopefully everyone understands that and can see that situation. So it's not working ideally for us in something that's trending. So what we do is we look for something that isn't trending. Because at the moment, this isn't really wide apart. Yes, it's wider than it has been, but it's not really wide apart. So it's not giving us an indication that there could be some kind of turnaround, is it? We're looking at a bit of euro strength. We're looking at the fact that the dollar is under pressure. And again, we have to add our fundamental and our technical analysis together. Tomorrow, I will talk more about that in tomorrow's webinar. But what it gives you, if we add our fundamentals and our technicals together, we can say, okay, well, why is this going up from a fundamental point of view? Well, it's going up because, number one, stimulus has been pumped into the US economy, unlimited amounts. That's leading stock markets higher from a recovery, and it's leading the US dollar lower, because that's how, in an economic movement, that's how markets work, okay? In economics, that's how it works, okay? Stimulus, cuts in interest rates, central bank quantitative easing, that all leads to assets higher, dollar lower, okay, or currency lower. So that's the situation that we have. So that's our fundamentals. What are our technicals saying? Well, our Bollinger Band is currently saying markets are ranging, they're at the top end of the band. Is it particularly wide? Well, it's not particularly wide. It's wider than it was in here, but excuse me, it's not particularly wide. But what we also say is we say, okay, well, let me add another form of technical analysis. Let me add another form of technical analysis. Let me put something in here which is going to confirm that to me. So I go insert, I go indicators, and I want an oscillator. And I want a relative strength index. And then we put that in. Let me just delete these. Where's the drawing tool gone? Undo, 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 undo. Okay. And again, guys, if you have any questions, then please ask. And a couple of people asking me, how do I start trading? How do I start trading? How do I begin? How do I do this? We have a bonus on at the moment. We have a bonus that if you fund your account, open an account with our team in Nigeria or South Africa, open an account and fund it with $250, we will give you 20% bonus money in your account. The $250 that you put in your account, that is in your account. It sits in this area here. You'll be able to see it. You'll be able to see it in here. This will be the money that you see in your account. Right there. You'll see $250. And you'll get 20% extra from us as a bonus. If you do $500, we'll give you a 30% bonus. If you do $2,000, we'll give you a 40% bonus. That's what there is in there. So please speak to our team in Nigeria. They will get in contact with you after the webinar, of course, as well. Excuse me. They will get in contact with you after the webinar as well, and give and be able to speak to you. But if you want to speak to them or go to our website and SM Invest, they will give you that information. Okay. So we added the RSI here. They added the RSI. And this is the situation that we have. Now, the RSI is a very simple overbought and oversold indicator. There's just been an excellent question come in, and I will answer it in 2 seconds. I will answer it in 2 seconds. So the movement here is we use the RSI from this point, and a breakout of 70 is overbought. But these don't necessarily work in trending markets. As we've said, these don't usually work in trending markets. Overbought, oversold indicators don't usually work there. So let's look for something that isn't trending. And on the hourly chart of Aussie, we have a market that isn't necessarily trending. We also have one in the oil price. If I can find oil, there it is. US oil markets. You can see a similar situation here. I could take this to an hourly chart. This will be perfect. Let me just delete some of these. You have this market here. So let's look. Insert. Indicators. Bollinger Bands. There we go. Perfect situation. Now, someone asked an excellent question a moment ago. And I'm going to answer it right now. How are you going to know the middle Bollinger Band is broken? Because from I've seen a lot of fake outs on your charts. Superb. Excellent question. So what we look at, there are going to be times when the market breaks through and it doesn't follow through what it's doing. Of course, this is the nature of a market. Okay, there are going to be times when we think it's going to go one way and of course it doesn't. But that is the nature of a market. There's nothing we can do about that. However, if you look at this situation, what we had previously was the fact that that was a trending market. Let's look at this situation now in a sideways market, oil. We can go back as far as you like here. So if you come back, so this was trending, this was big moves, this is very wide. We can't necessarily use it because the volatility is too much. So we're too wide. So let's look at this on a smaller basis. So we look here and let's take it from this point here, because we could go from here, but I think that's still a bit too wide. It's a bit still a bit too erratic. Let's look here. Market broke out. Now we're always going to get this situation, and let me zoom you in here. Let me zoom you in and just take you along to it. Just take you along here. Right here is what I'm talking about, right here. Okay. The market fell. Yes, it fell. And yes, it jumped back higher. There's two things we have to think about here. That's not a fake breakout because look where we went. But this is how we must always think about the market. It gives us signals, but the nature of a market is that when there are big falls, there are also turnarounds. You can see that throughout what we've seen over the last couple of weeks, is that there's been massive falls one day, followed by falls back the other way. Retracements back the other way, not falls. So we see one movement one way, and then we see another movement the other way. Okay, that happens loads and loads and loads. So let's have a quick look. If this breaks, this is a big fall. Yes, sometimes we are going to get an upside move like this. So breakout, upside move. Now look at the movement lower to our price target. Let's look at it going up. Market comes higher. So let's look at where we're going. So what is our signal in here? And yes, okay, I'm using things which are in the past, but of course, this is the only way we can. So our buying signal is here. That's our buying signal. But market dips down. Then it comes through again. So we go, what we wait for in the market is we wait for confirmation. And confirmation in this situation would be a close above this moving average. Now the candle hasn't closed here. Yes, it's broken above it, but it hasn't closed. So I'm looking for the market here. I'm looking for this and thinking, okay, there is potential. I would wait. I wouldn't be buying here. I would wait. Market falls lower. Am I buying here? No. Chances are I'm not buying there either. Market comes in here, then I look to buy again. So my buying signal is here because what happens here? The market closes. Oh. The market closes. The market closes, and this then gives us our signal. So that is then the situation that we have. So this, oh, this is an indicator, but this one here, that's our buying signal. Now, someone's asked me, do we not expect to buy when it's lower? Well, of course, we want to buy at its lowest point. But to buy at this lowest point, you have to have a signal to trade. And I could easily say to you, well, yes, I would want to buy here. But of course I would want to buy here because that is a perfect world. In a perfect world, I buy here and I rally this up. But it's not a perfect world. So I'd want to see confirmation that this happens. And then I take this out. And then for me, you can take it to your price target, which is the top Bollinger Band. And you come out up around here. Now, yes, if you're buying on the next price here, you're not making as much as you would have done from this lower point, or of course from down here. But we don't know the market's turning here. So the market is giving us an indication. We're not going to get in at an exact point. It's like this downside move. I would like to sell here and ride it all the way down here, but I'm not going to, because yes, there's the downside, but if I'm using Bollinger Bands, I wait for a break of this level. So there's our selling signal. Now, in this case, I don't need to wait for confirmation of a break because this didn't happen. We just saw this continuously sell off. So the chances are we enter the market at, where do we enter? Well, somewhere down around here, probably. So again, if I use an arrow here, it's probably somewhere around there. And then we're taking this sort of price out. So you can see that there's situations within this. And in a ranging market, it gives us a much better indication of how this stuff is moving. There's another question here I just want to get to. Very good question again. Okay, so I'm just going to go through it a little bit here. So someone's asked me that I mentioned that the price target is the upper and lower band, upper, lower. And when the price closed above or below this middle band, have I noticed that sometimes the upper band will be broken too? And the buy obviously continues, the market still continues higher. Question is, how can we know the trade to hold as the price hit the upper band or the lower band, or to wait and let it continue? Well, this is a tough one. Now for me, I always say that the key thing is to make sure that when we trade, that we're taking something out. So if you have a target and your target is there, don't leave it to continue. Okay, don't leave it to continue. In this situation, but if you want to do that, if you're in a situation where you want to do that, then you can say, okay, instead of, say I bought 10 lots. Let's say for argument's sake, I bought 10 lots. Whatever it may be, you might have bought 5, might have bought 1, you might have bought 100. It doesn't matter, whatever it is. We'll say for argument's sake that we bought 10 lots on this break, okay? Now, when it got up here, if you still think it's going to go higher, what I would say is I would say sell 5. So sell 5, cut your position. So cut your position in half. So you still have some position if the market keeps going higher. Which this did here. It did to a certain degree. Same thing happened here. But you have to be very close in the market to be able to pick these points off. To be able to pick them off, you have to be very close and be very much in the market. Hopefully that makes sense to everyone. Hopefully that makes sense and you understand how these Bollinger Bands work. We're close to the end here now. Markets are, let me just find out what markets are doing exactly here. Markets rapidly higher. So we're flying higher in markets at the moment. Dow Jones up over another 1,000 points higher, 1,100 points higher. S&P up 115, 4.6%. Dow up 5.4%. Massive moves, massive moves. So we're seeing some more massive moves today. These markets are very much alive with opportunities. That's why now has never been a better time to open accounts with us at SM Invest. Our sales guys will be talking to you and they will be speaking to you and they'll be giving you the information about how you can sign up and where the money that you deposit goes into your trading account. As soon as you deposit that money into your trading account, you will be able to trade and take advantage of the strategies that we have in here. I'll be doing more webinars, one more this week, tomorrow, and then more next week as well. Okay, so I'd love to see you all join there. Now, remember, if you sign up for an account and you deposit this week, you have to deposit this week, you will get, for $250, you'll get a 20% bonus. For $500 deposited, you will get a 30% bonus. And for $2,000 deposited, you'll get a 40% bonus. All of these will go into your trading account and they'll be available to trade. Guys, thank you very much for your time. It's excellent having you all here and excellent questions coming in from you guys. So thank you very much for that. Please send me an email after this. There is an email address in your registrations that you can get to. If there are any topics you would like me to cover, if there's anything you want me to talk about, and if you've funded your account, I can send you more emails and I can talk to you. Excuse me. I can send you more emails and talk to you about these things. The recording is available. I will send the recording. If you fund your account, I can send you the recording and you'll be able to, you'll be able to watch this all over again and see how this works. But please, thank you very much for joining. If you do want to fund, remember our bonus exclusively for these webinars, 20% for $250, 20% for $250 for $250, 30% for $500, and 40% for $2,000. Remember that $2,300, $250 that goes into your trading account. Name of the broker, SM Invest. SM Invest in Nigeria. Guys, thank you very, very much indeed. Let me type you the answer. There's the answer. Guys, thank you very, very much indeed. And I will speak to you again. Thank you very much.